Hey everyone, welcome back to The Explainer. I'm your instructor, Sama Herakli, and today we are diving deep into Day 25, the Accounts Receivable Audit. Now, if you follow this space, you know we absolutely love unpacking governance, risk management, and internal controls. Well, today we're exploring one of the most absolutely critical areas of any financial audit to see exactly how businesses keep their revenues secure. Let's get right into it. Okay, here is our roadmap for today. We're going to start with the foundation, objectives, and risks, then walk through the order-to-cash process, look at procedures and audit assertions, dive into a customer confirmation example, flag those red flags you need to watch out for, and finally wrap up with the impact and key takeaway. So before we get into the weeds of the audit itself, let's just ground ourselves in the definition. Accounts receivable, or AR, simply represents amounts due from customers for goods or services sold on credit. Basically, it's the money people owe you. Say your company ships 100 laptops to a client with net 30 payment terms, well, that value sits right there in AR. And our job with an AR audit is to evaluate the accuracy, existence, valuation, cutoff, and collection of those receivables, plus figure out if the internal controls are actually doing their job. All right, Section 1, Foundation, Objectives, and Risks. We have 5 major goals we have to hit here. First, we've got to ensure receivables are recorded accurately and completely. Obviously, you don't want a $10,000 invoice accidentally recorded as $1,000. Second, we have to confirm existence, as in, is this a real debt owed by a real, breathing customer? Third, we ensure proper valuation and classification, like making sure receivable is correctly categorized as short-term versus long-term on the balance sheet. Fourth, we verify timely collection. And fifth, we evaluate control effectiveness to make sure the system itself is actually protecting the company's assets.
Now, what keeps auditors up at night? The risks. These are the very real threats businesses face every single day. We have to watch for revenue recorded before goods are even delivered, which is a classic scheme to artificially pump up quarterly earnings. We also have to watch for fake or duplicate customers. Think about an employee literally creating a dummy vendor in the system just to siphon money out. There's also the risk of incorrect pricing, unrecorded receivables, long outstanding balances, and inadequate allowance for doubtful debts. You know, like when a client goes bankrupt but management refuses to write down the receivable because it'll hurt their numbers.
So how do we fight back? With our key controls. This is your defensive playbook. We need credit approvals to make sure we aren't lending to someone who can't pay. We need a proper sales order review, timely invoicing, and periodic AR to general ledger reconciliations. We also need aging follow-ups, strict write-off authorizations, and, this is a big one, segregation of duties. Actually, let's emphasize that. The person processing customer payments should absolutely never be the same person authorizing a bad debt write-off. That is just a massive recipe for theft, right? Moving right along to Section 2, the order-to-cash process. The AR cycle generally follows a pretty standard 7-step chain. Step 1 is the customer order. Step 2 is credit approval, where we vet that specific customer. Step 3 is sales order and delivery, which is when the goods actually change hands. And Step 4 is billing, generating and sending the invoice. This first half of the cycle, it's really all about flawless execution and documentation. And finishing that cycle out, we hit Step 5, collection, getting the cash. Step 6 is receipt recording in the accounting system. And finally, Step 7 is reconciliation. And listen, this is crucial. If any single link in this entire 7-step chain breaks, the whole accounts receivable balance becomes totally susceptible to major errors. Okay, Section 3, procedures and audit assertions. Here is our actual battle plan. First, we have to understand the process and the controls. Then we test their design and operating effectiveness. We do walkthroughs, which basically means taking one single customer order and manually tracing it through all 7 of those steps we just talked about. We also confirm balances directly with customers, review subsequent cash receipts, analyze the aging reports, review write-offs, and reconcile everything back to the general ledger. Now we get to the core assertions, the real why behind the what. First up, existence. Do these receivables actually exist? We aren't just looking at a spreadsheet here. We want to see the shipping documents and the signed contracts. Second, completeness. Are all receivables recorded? For instance, if you physically shipped a pallet of goods out of the warehouse on December 31st, you have to ensure that specific receivable is actually captured in that same year's books. Next, we've got accuracy. Are the amounts recorded correctly? Literally just checking the math on the invoices against the master price list. Then there's valuation. Are receivables stated at net realizable value? To put that in perspective, if a customer owes you 100 grand, but they're actively in bankruptcy and you honestly only expect to get 50 grand back, the valuation assertion says you have to state that receivable at 50,000, not the full 100. Wrapping up the assertions, we test. Cutoff, are things recorded in the correct period? No recording January sales in December just to hit a year-end bonus target. Then, rights and obligations. Do you actually have the right to collect? If a company factors or sells its receivables to a third party, they don't have the right to collect anymore, so it shouldn't be on the books. And finally, presentation. Are the disclosures appropriate and transparent for anyone reading the financials? All right, Section 4, Customer Confirmation Example. So let's look at how this plays out in the real world. We have a customer, XYZ Private Limited, with a book balance of $250,000 on March 31st. The auditor sends out a confirmation on April 10th. The customer replies a week later on April 18th. And they confirm their balance is exactly $250,000. Boom, this perfectly satisfies our existence and accuracy assertions. Because those numbers matched up perfectly, it's a clean test. But, and this is a big but, any differences have to be investigated and resolved. It's often just a timing thing. Like maybe the customer mailed a check on March 30th, but you didn't physically receive it until April 3rd. It's on you as the auditor to dig in, investigate that gap, and prove it's just a timing difference and not missing cash. Section 5, Red Flags to Watch. You absolutely have to be on the lookout for these 5 warning signs. Number 1, high balances with really old outstandings. Number 2, invoices with 0 supporting documents. If there's no shipping receipt, did the sale even happen? Number 3, frequent credit notes or write-offs. Someone could literally be stealing cash on writing off the balance to hide their tracks. Number 4, customers sharing the same address or contact info. If a vendor and a customer share a P.O. box, that is a glaring red flag for a shell company. And number 5, discrepancies in those customer confirmations we just talked about. Finally, Section 6, Impact and Key Takeaway. So what's the actual payoff of all this hard work? A rigorous AR audit guarantees accurate financial reporting. It improves cash flow because you're staying on top of collections. It reduces your credit risk and bad debts. It naturally builds stronger internal controls. And honestly, it just makes for better customer relationship management because when your billing is accurate, you don't have to deal with messy disputes. If you remember literally nothing else today, remember this key takeaway. An effective accounts receivable audit ensures that the amounts due are real, correctly stated, properly recorded, and collected in time, fundamentally supporting the entire financial health of the organization. I'm going to leave you with this final equation because it perfectly sums up everything we've covered today. Good controls over accounts receivable equals better cash flow, plus lower risk, plus a stronger business. So as you head back into your own day-to-day work, I want you to ask yourself, how are you going to ensure these controls are bulletproof in your very next audit? Thanks so much for joining me for this explainer, and I'll see you in the next one.